Hello and welcome back to Equity Merchants on Business Front TV, the show where we track the capital flows driving growth across Africa's key sectors, from tech and finance to agriculture, infrastructure, health, energy, and beyond. I'm Chimgo's Rim, reporting from Lagos, Nigeria. First, a look at the headlines. ArcelorMittal rejects $400 million bid from South Africa's IDC. Coolbox raises $11 million from Kawisafi Ventures. Union Bank Titan merger finalized as Unity Providus move toward deal. Negotiations to acquire ArcelorMittal's South African operations have hit a roadblock, with both sides unable to agree on a valuation. South Africa's state-owned Industrial Development Corporation reportedly offered nearly $400 million for the struggling steelmaker, but that bid was rejected. ArcelorMittal previously warned it would shut down local operations by the end of September 2025 if no viable solution was found. The company posted a $57 million loss in the first half of the year and saw revenue drop 17% to $968 million. If operations do cease, around 4,000 jobs could be lost, and that's the scenario the South African government is eager to avoid, especially as it grapples with the economic impact of US tariffs. Coolbox has raised $11 million in Series A funding through a mix of equity, debt, grants, and results-based financing. The company, which provides solar-powered freezers to small businesses and traders across Africa, uses a pay-as-you-go model to make cold storage more accessible. Since its launch in 2018, Coolbox has deployed over 10,000 units across the continent. With this new funding, the company plans to build an assembly plant in Nigeria, a move aimed at reducing production costs and improving affordability for customers. Nigeria's banking sector is seeing a wave of consolidation. Union Bank of Nigeria has completed its merger with Titan Trust Bank, absorbing the younger institution and operating under the Union Bank brand. The deal expands Union Bank's reach to 293 branches, 937 ATMs, and over 7.3 million customers, following Titan Trust's 2021 acquisition of an 89% stake. Elsewhere, Unity Bank has announced progress in its planned merger with Providus Bank. A federal high court has ordered Unity Bank shareholders to meet on September 26th to vote on the merger scheme, which would see all Unity Bank assets and liabilities transferred to Providus. Shareholders can opt for cash or shares in the new entity. Now to Egypt, where fintech company Valu has officially listed on the Egyptian Stock Exchange, a major milestone in one of the region's fastest growing sectors. Joining us now is Walid Hassouna, CEO at Valu, to talk about what this listing means for the company, the fintech space in Egypt, and what's next in their growth journey. First of all, how long have you been working towards this? And then why did you ultimately decide to list Valu on the stock exchange?
Yes, so we have been ready actually for an IPO since 2024, in March 2024. The decision was taken in the end of 2022, and we were preparing documentation, structure, and everything that helps us to go for an IPO. As you know, IPO requires a lot of transparency and a lot of governance, and as a startup, we needed around a year to be ready. Unfortunately, 2024 was a very difficult year to IPO. The market was not very good here in Egypt because we decided we're going to IPO in our home market. And the market was not very good due to FX issues and very high inflation rates, also massive increase in the lending rates that we were receiving from the banks because of the increase of the policy rate. By the end of 2024, we had excellent results, and we decided that in November 2024, we decided we want to go public, and we're ready to go public. And we were lucky enough that the Financial Regulatory Authority in Egypt and also the stock exchange were very happy with the structure that we submitted for them. It was not a real IPO where we raised money, it was more listing in the stock exchange. And the reason behind that we didn't need to raise any money at the point. The company was self-sufficient, so dilution was not an option for us. But we had a major, and we still have a major shareholder, which is EFG Holding, that at the time owned 87% of the company. The rest was distributed between us as management and some of the VCs that were part of one of the acquisitions we have did in 2022, a company called Paynas. EFG decided to distribute its dividends for this year in the form of value stock. And they decided to do this at book value. So this was around 1.5 cents of a dividend distribution. And our current market cap would give those guys a huge upside of around 10.5 cents. So it just raised 10 times, increased 10 times. We are IPOing because we think this is a very good exit for our shareholders. Now they have an open market where they can sell the product and they can sell the shares, which I think the most important thing. Also, it helps us in case we want to raise money in the future to have direct access to public markets. Especially Egypt is known for a lot of institutional investments, as you know, in its public market. So the reason behind that was also to be able to raise capital easier to fuel our market expansion, especially in Jordan.
Awesome. So now you've mentioned that you did not necessarily need to raise money at the time you listed on the exchange, but this was also a partial listing. Can you share why you did not do a full listing and chose to go with a partial listing instead?
In Egypt, it's very important for the main shareholders to have a lockup period because it protects small investors. So no one would go into a full listing because this will mean that the main shareholders will be able to sell 100% of their holding. And this happens only a year after based on the Egyptian law. So partial listing is the way that every company in Egypt could start an IPO with, and then followed 1 year after every single share becomes unlocked and accordingly we reach a full listing.
Okay, awesome. I know this has just been a month since you listed, but what has the response from the market been like?
Actually, the market responded very well. We had an excellent roadshow in the UAE and in London. And also virtual roadshow with investors in the US. Luckily enough, now we have around 20,000 shareholders in Valu, which put it as one of the biggest shareholder base in Egypt right now. Since we launched, we have not fallen below the fair value, which is equivalent to around $350 million. And the company has also a lot of liquidity on its stock, so the stock has been very liquid. And good news, last week we got approved and admitted to marginal lending index in Egypt, which means people can borrow money on our shares and can do marginal borrowing on our shares. So since then we have seen a very solid market for our shares, and we have seen a lot of volume being traded and exchanging hands in the market.
Awesome. So just zooming away from Valu right now and looking at the broader African ecosystem, why do you think we've seen very few listings in Africa from tech startups, whether partial, just like you've done, or full listings?
I think there are multiple reasons. The first reason is the stock exchange markets in Africa are not as big as the others in the GCC or Europe or the US, of course. So this definitely puts a lot of pressure on listed companies because with listing, you need to have liquidity. And if you're not going to have a liquid share, then you have a problem on that, for sure. This is one thing. Second thing is the way startups has raised money in the past was always done through VCs. And basically VCs would like to see more of M&A transactions where they have a full exit and not a partial exit as what happens in the stock exchange. Also, it puts a lot of pressure on VCs because they will have to market the value of their shares based on the change in price on daily basis. While if they do multiple rounds, then definitely they can market based on the most recent round. So I think it's two things: a macro level on how liquid the market is in Africa and when it comes to stock exchanges, and the other thing which I think it's important that VCs would prefer to have a full exit via an M&A transaction to be able to post their returns. But to be honest, Egypt has witnessed a lot of exits for fintech companies, and the most known one would be, other than Value, would be Fawry. Fowley was able to do an exit through stock exchange a couple of years ago, and most of the PEs and VCs were able to exit with 10x of returns. So Egypt remains to be the flagship for exits for fintech through the Egyptian Stock Exchange.
Awesome. So just what do you think can be done to encourage more startups? I know we've talked about the macro, which makes it a bit difficult because that's not really something you can control as a startup. But what can we do to encourage more startups across Africa to list publicly?
Yes, I think the first thing, they have to be ready for listing. So they have to have excellent governance. And as you know, unfortunately, when you are a startup, it's very difficult to apply the governance benchmark. So one thing they have to work on is to make sure that they have excellent governance. Second thing is transparency. And I think most of the African startups, they lack transparency when it comes to the rounds they raise. You never know what was the valuation. Of course, there are few exceptions to that, but most of the startups will not declare what valuation and what structure they raised money through. So the second thing is transparency. And the third thing, which comes with a lot of cost, that they need to have also a functioning investment relation department. And finally, they have to have access to asset managers, because basically once you become listed, you start having a very different class of investors. Not your normal VC PE structure, but mostly asset managers that mostly invest in across the world, not in a certain sector or in a certain country or a continent.
So just to what extent do you think that startups on the continent seeing events like your listing, to what extent do you think that listing like this can help to solve the exit challenges that we have across Africa?
I think this is the best way to exit in Africa now, given what's happening in the market and what's happening in Africa specifically. The best way to exit or to partially exit is to be ready for a listing. Listing will help a lot of investors to have access to data that they normally don't have access to, and it might actually grab the attention of big players or strategic players to fully acquire those companies, because now they have real access to data, they have earning releases, they are sure about the quality of earnings and other things.
Family offices are a relatively new addition to Africa's financial landscape, but they have the potential to become powerful drivers of economic growth. In this conversation with Theodore Albright, Managing Consultant at the Family Office Africa, we explore how these private wealth vehicles can move beyond philanthropy to fund African businesses, the importance of strong governance structures, and what it will take for family offices to scale their impact across the continent.
In essence, a family office is a resource to family businesses or family-owned businesses or business families, high net worth individuals, C-suite executives, and some SMEs. And the support normally comes in so many different flavors, but the critical areas are strategy, governance, tax, legal, leadership, financial planning, audit, compliance, and wealth management. Those are the sort of suite of services that your typical family office will provide. I must say that there are two main types of family offices. There is the single family office, which normally provides support to an individual and his or her family. So Bill Gates, Dangote, Oprah Winfrey will have their own family offices targeting and addressing their own need, including concierge services. Then you have the multi-family office, and there are two kinds of that too. There is the independent multi-family office, and then there is the collaborative multi-family office. And typically, the collaborative multi-family office is where you have a number of families, wealthy families or individuals coming together for support and consuming the resources that I've already mentioned. We at the Family Office Africa operate an independent family office. That means we are consumer and customer client agnostic. We take all comers who need support in the areas that I've outlined, so compliance, wealth management, tax, trust structures, onshore, offshore, legal transactions, strategy, leadership, and beyond. The ultimate objective of any family office is threefold. One is legacy, two is succession planning, and three is intergenerational wealth transfer. So although family offices have existed for about 600 years across the globe, in Africa, you're right to say that it's a very recent phenomenon. And I'll say that, in fact, multi-family offices are very few, far and between in terms of the continent of Africa.
So just speaking on how African family offices can play in innovation or just spur economic growth. First question, just briefly, do you think that we are at the scale, considering the scale relatively early, do you really think we are at the scale where we can demand that these family offices support economic development across the continent?
Undoubtedly, yes. And I'll tell you why. SMEs are the engine of growth across the world.
Yeah.
And by SMEs, I mean small and medium-sized enterprises across the world. The conglomerates are few and far between. So as a percentage of economic growth across the world, I would say that the economic activity represents about 65% and as high as 80% in some jurisdictions. So say Cuba and North Korea, pretty much all economies depend on small and medium-sized enterprises. Okay. And so those are the engines of growth wherever you go, whether it's Germany, America, Italy, or France, or for that matter, the United Kingdom. And when you look at the Far East as well, you can see Hyundai and Samsung. All of these are family businesses which have scaled. When you look at BMW, Mercedes, these are family businesses which again have scaled. And they have, in a sense, we no longer look at them as businesses which actually belong to families. So as a starter for Africa, we definitely need to stoke and stimulate economies. And if we accept that SMEs are the engines of growth, then no matter how small or large in terms of scale compared to our Eastern or Western or Southern global Northern counterparts, the fact that we have started on this journey is critical. Are we at a point where we have the same scale as Nvidia or Apple or Walmart? No. But we must stimulate our economies. Granted that on the continent, the biggest spenders are governments. But we can't leave everything to government. And so this is where SMEs and family-owned businesses come in to support the drive and the agenda for accelerating economies on the continent. And how do they do that? They do that perhaps in three critical ways. One is running their own businesses, whatever it might be, whether it's a cement factory or an oil refinery. You know what I mean? Two is the adjacencies. You know, industry does not exist in a vacuum. All right. And so by setting up the businesses, you grow a whole ecosystem around it. And then three is direct or indirect investment into the businesses that we have within the on the continent in the various countries. So the original businesses like Dangote will have the adjacencies, the businesses that live within the ecosystem that he has created, and then the further investments that may go into new and fledgling businesses. So yes is the answer. I think that no scale is too small, and we need to start from the embryo and begin to grow the machine that will drive the agenda for Africa.
All right, so now let's look at capital and family offices as a source of capital. For the most part on the continent, we either have donor-led funding, we have funding from commercial banks, that's lending, and when you look at the tech space, we have largely venture capital, and in just a few cases, private equity. But apart from these four major sources of funding, what unique advantage does a family office hold over all four?
The truth is that funding on the continent of Africa has always been a thorny issue. And when you individualize it, and I look across the continent, I look at different countries from which we operate, the feedback is always the same: seed capital or capital to commence. But I have to say that we, as family offices, some and very few are venturing into, like you said, venture capital or private equity, or coming alongside for joint venture projects. In the main, what I see is the funding, the cycle of funding being reintroduced into the ecosystem of the family. So you have families who have liquidity, and that they use that liquidity either to buy in expertise or set up adjacent businesses. So in the ecosystem, you might even have a VC fund for funding members, either direct or indirect members of families for businesses. But I have to be honest and say, it is not often or frequent that you find the money or the funds leaking out of this ecosystem into setting up externals like angel investing. Far from it. For the most part, the funding remains within the ecosystem, and if investment is to be made, then it is either in the form of joint venturing or acquisition, but not to say that I'm giving you, doling out funds as an impact investor or venture capitalist, not outside of the ecosystem.
Okay, so what do you think is the biggest problem with this? Why are they not doing a lot of investments outside their ecosystem?
Opportunity cost. Simply put,
Okay.
funding and cash will go where it is most appreciated. Simply put. So if I am a funder and I have a pot of 100 million, I will look at where I can optimize and maximize my returns. Maximizing my return without optimizing is dangerous, because it means that I'm going for profit maximization, but I've not taken account of the risk. So the optimization then takes account of the potential risk involved in going outside of the ecosystem. That is number one. Number two, the bride, that is the potential business, quite often is not ready in terms of governance to accept the new funding. I work for clients who, in some instance, would wish to go out and put funding into organizations. But the question is, what are the stakes from a governance perspective of those institutions? And so often my first advice to organizations or companies or entities seeking funding is to get your house in order, which means that the governance structures must be put in place. What do I mean by that? At the ownership level, we need to be very clear what is expected. At the control level, here, this is the board level. Do we have a board? Do we have independence at the board? Do we have meeting rhythms? And so on. And then at the management level, we're looking at processes and policies. Are those in place? Are those adhered to? And so that comfort is what is needed for funding to be able to flow. So I am maximizing, but I'm also optimizing by looking at my opportunity cost. Where can I optimize and maximize my returns? But I don't want to do that by getting my fingers burnt. And so governance then becomes a critical tool for preparing the bride to accept the bridegroom who is going to fund you.
I mean, you raised some really important points there with how governance or the lack of it is basically hindering these family offices from doing investments. But it also raises another question for me. Considering governance is such a thorny issue for them and something that they want to guard against, what role can they play, or are they already playing, in bridging this governance gap? Because this is a problem. One, because a lot of African businesses aren't formalized, so they're just, if you're informal, you probably do not have the governance in place. So what role are these family offices taking to ensure that there's some level of governance, even if it's not as great as they would like it? What role are they playing to ensure there's some level of governance in these businesses?
I think it is important that we set the scene. You know, family offices are not charities, okay? Invariably, they're in for significance, they're in for impact, they're in for legacy, okay? And so there's a limit to what a family office can and will do to support businesses that are interested in growing and in ensuring that they have the proper governance structures in place. I take us, the Family Office Africa. There is hardly a month where we don't offer free, and I mean free, webinars to associations of businesses. So Institute of Directors, Chartered Institute of Marketing, Association of Corporate Council, and other compliance organizations to support them in putting in the structures. And we do that from a very selfish perspective. Why? Because when the governance structures are put in place, it means that we will have, in terms of our pipeline of clients, better clients for whom we can now make introductions. So that is number one. But number two, because we live in the ecosystem, it means that we have a buoyant economy. So what we then drive is a virtuous cycle of businesses getting their acts together, businesses being more favorable for the receipt of funding, Businesses now striving and thriving within the economic ecosystem. Recently, we held a summit with the IFC, the arm of the World Bank, where we brought together family businesses and spoke on the issue of governance and how to put in structures. Last month, we held the Africa Family Business Summit here in Accra, again with the view to driving the conversation around structure, around governance, around systems and processes. So it isn't that we are not doing, but I have to say that the businesses have to take responsibility for their own governance. So we create awareness for sure. We offer assistance, no doubt, but ultimately the businesses need to be proactive if they want to scale and they want to grow.
So what are some of the biggest opportunities that you see for African family offices that want to help spur economic development?
I think that I take Africa as a virgin forest. And I think that Africa is at an inflection point. If we take the right steps, in the next 10 years, we should see an economic boom that like never before. It means that family businesses can intervene, step in, and take the lead in the direction of travel for the continent. We are resource rich in natural resources, but in terms of expertise, we seem to lag behind. And therefore, the value add is not there. Let me give you a few instances. Between Nigeria, Ivory Coast, and Ghana, we probably supply 70% of all the cocoa on the planet. How is it that we are not going the next step to forward integrate by adding value to the cocoa bean? Rather, we are exporting the bean raw. We are exporting the bean raw. Straight away, I see an opportunity to add value to the bean in terms of its journey to the chocolate bar. That is a classic example. We should not have 80% of the cocoa beans leaving the shores of Africa to be processed elsewhere. Why is it that it is taking one businessman to craft and build an oil refinery in an oil producing country? Where is the value add? So the opportunities are in the value addition to the natural resources that are abundant on the continent of Africa. When you add on to that the Africa Free Continental Trade, you have a unique mix of opportunity on the continent of Africa for the dynamo of business to be generated and to be accelerated.
We're wrapping it up now with the last question. So over the next decade, what role do you envision for family offices in Africa?
3 critical roles. Remember, family offices are built for intergenerational wealth transfer and succession planning. In Africa, like other parts of the world, we are plagued with the perennial curse of shirt sleeves to shirt sleeves. The first generation makes the money, the second generation saves the money, the third generation squanders the money. By setting up the family offices, you no longer have to reinvent the wheel by going back to base station. It means that you have continuity in the business environment and you have growth. And so we can see second, third, fourth, 10th generation businesses. And as they grow, quite often so they scale, because they have family businesses and family owned businesses have a unique point of view, which is they invest for the long term and they're willing to take greater risks. So that is number one. We create a virtuous cycle and we don't go to boom and bust of after the first generation, the founder dies and that is the end. That is number one. Number two, family offices then become a beacon of inspiration and knowledge transfer, as well as creating ecosystems within which adjacencies can develop and grow. Dangote has a cement factory, Dangote has an oil refinery. And so the adjacencies around that means that new skills and new education insights, knowledge, and expertise is developed and accelerated. And then the last bit is that with the acceleration of the family offices, you will now have liquidity with which to look at the value additions that it can bring on the continent of Africa, as in going the next step on oil refinery, going the next step on gold smelting, going the next step on cocoa processing, going the next step in agribusiness, in the mining sector, in the telecom sector. So ours is a wonderful opportunity for us to behold. The mix then, the special sauce of the Africa free trade, if it comes to fruition and is taken seriously, will make Africa the powerhouse that it has always had the potential to be, but it's only now realizing its potential dream.
Africa's 54 countries present a vast opportunity, but also a complex regulatory puzzle for businesses and investors alike. Today, we are unpacking how this regulatory fragmentation impacts cross-border expansion and halts investment prospects across the continent. Joining us to break it all down is Dr. Austin Okpagu, Country Manager at Veto. In your opinion, and from your experience as well, why do you think that regulatory fragmentation is such a huge barrier to Africa's economic development and investment potential?
Yeah, absolutely. Thanks for that. I mean, there could be several reasons, right? Let me give you a context.
Yeah, perfect.
Have you ever tried to visit another African country?
Yes.
And you need visa.
Yeah.
Let's say South Africa. And you have to wait for weeks, in some cases, to get approved to visit. And why? Because even more so because this is also within the same continent, but you need some sort of harmonization in terms of, or integration within the continent. Government in Nigeria, government in South Africa, or even in other African countries, to be able to get that authorization for you to even visit another country. More so if you need to do business. So you have to, in fact, business is supposed to be spontaneous, right? But just imagine you have a deal to do in another country, another African country, and you have to wait for weeks to get visa. The business person would have moved on, right? And it would probably be much more easier for that business partner, your prospective business partner, to do business with the world than even within Africa. And that's one of the biggest challenge, right? So aside from the fact that there need to be harmonization in terms of even ID verification, for example, right? If you need to move from Nigeria to Ghana, for example, there's no way that the Ghanaian authority would be able to snap and say, you know what, we know who this person is, because what they require to verify you is different from what they require, what the Nigerian, business environment or regulatory environment or landscape require, right? So I think those are some of the issues from the government's perspective, but there are much more other issues. We can think about infrastructural issues. So, yeah, you can think about regulatory issues in terms of lack of harmonization of identity, which one of the biggest problems, and also in terms of inconsistency in policies within the continent as well, forming some of the barriers, the biggest barriers to businesses. And I'm sure you heard recently about, passporting.
Yeah.
I think licensed passporting, right? And which is one of the things that proponent of that initiative is aiming to achieve, so that when you have a license in Nigeria, for example, you should be able to do business in another African country. It means the regulators in those countries already recognize that you do have the permission to do business in your home country. As such, you do not need to start from the ground up to be able to assess their market. You know what I mean? Yeah.
Oh, okay. So are there examples within Africa or maybe even outside Africa that just shows how harmonized regulations can drive investment and innovation? And what do you think we can learn from these countries or from these regions?
Yeah, absolutely. So you look at what is happening in terms of AFTA, right? You look at what is happening with PAPS, and those are some of from the regional government perspective, that's what is happening. Again, you also read recently that the Kenyan government have just allowed visa entry free for Africans, right? What that means, you can literally fly, to Nairobi without having to, even though you have to obviously apply for these things online, but even visa on arrival are some of the things that could ideally solve these problems. And I think that's happening across some markets, some countries in Africa. And the aim really is to liberalize trade in the real sense. It means that, and I think that's the right step in the right direction, until, even if you have an ECOWAS passport in the true sense of it, which most Nigerians do have, it doesn't really give you free access to move within, the region. And so, but we are beginning to see fragmented effort from different countries within the continent that I think is the right step in the right direction. Aside from Kenya, you also look at their countries like Uganda, Tanzania, for example, is also doing something in that direction. Even though I understand that there's some little, some bit of restriction right now in Tanzania, where some specific sectors, foreigners are not even allowed to do business in those sort of sectors, right? Yeah. Again, which I think, in my personal opinion, is a setback in terms of what we what we actually expect to see within the continent, where aside from the freedom of movement, but there should be some, some leverage in terms of foreigners or Africans to be able to go to one country within the continent to set up businesses without being impeded by some regulatory red tapes. That is the norm today.
So a key challenge when discussing harmonization of regulations is national sovereignty. So every country wants to be able to do what they want to do without having others dictate how they get to do that. Like you've mentioned, in Tanzania, they want to keep certain sectors within or under the purview of locals. And there are often some fairly good reasons for this. But how do you think that countries can balance national interest on one hand, or sovereignty on one hand, and then the need to ensure that their sectors are open for business, and that the country itself is not inadvertently hampering development in that country?
Look, that's a very vital question. I think that's one of the biggest barrier that most African leaders, right, are contending with. How do you ensure that, you open up your country to other African, citizens, to come in and do business without, it affecting your sovereignty, right, as a country? And we can see some very good examples. Today, if I think it has to do with more so about the implementation of that policy, right? Okay. And I think that's why a lot of leaders within the continent are spending decades thinking about it. Have you ever wondered why the one currency in Africa hasn't taken off, right? It's the same fear. But if this works in Europe, why couldn't it work in Africa? And I think that's the puzzle, and that's a question that we need to ask. It's not like we're asking for things that haven't been done in other countries or in other continents. It works. It's the suspicion within the African leaders that has created this. This should have taken off. But I hear that I think maybe in 2030 or 2029, I'm not sure of the exact date, where EU were saying we would think about having common currency, right? And this is to take care of this kind of concern. But I think it's in terms of balancing. If you look at Africa, it's a bloc. You have the EU and then you have the ECOWAS. I think if you look at what has happened in between Niger Republic, I think is it Mali, or 3 African countries, they've had to form their own bloc as well, right? And what was the aim? The aim was for them to make sure that they integrate within themselves and do business within themselves, not even from ECOWAS, right? Because they've had to exit their countries from ECOWAS. But I think it's just around the way the policy is being formulated, right? Which is the first step. The first step is having an ECOWAS passport, which already exists. Ensuring that the database, right, across those countries or member countries is harmonized. And that has to do with integrations, such that all you need, for example, you have an NIN, and NIN does not probably exist. It's not probably called NIN in Ghana or in South Africa. But it should be done in such a way that the moment you impute NIN or BVN, right, it can automatically sync or bring in details, right, about that individual or about that business, right? And that's such that when you do anything that could affect, the country that you intend to do business, it's easy to flag. If you look at what has happened recently about the tax bill that have just been, signed off, what was the aim? Is to harmonize, right? All the taxes. It's the same approach. And so if you use the same model, it takes a bit of time. There will be confrontation. There will be agitations. Why not to do? Why you should do it or why you shouldn't do it? But the reality is that it just has to do with harmonization, such that everyone still retain their authorities, and you retain the authority to deport when you have to, retain the authority to kind of also generate the right revenue that you should generate. And if there's a need for even revenue to be shared among the cooperating country, right? That is also possible. So, but to answer your question simply, it has to do with the way the framework is being designed, right? And I think that we're thinking of building the whole stuff at once. Mm-hmm. But I think that the approach would be that these countries should be building layer by layer. Today is Kenya, saying, you know what, you can come to Kenya and do business without needing a passport. That's one step. And I think that the next step ideally would be that, okay, how do you move from that to ensuring that people can set up businesses in Kenya or in any other African countries from their home country without having to own a physical business, address, a business office in that country, but there's a way it can be tracked. I'm sure you know merchant of record it's already ongoing. Yeah. There are startups doing merchant of record MOR. And what is M game? This is basically what it is. Why is an MOR even in existence in the first place? Is because of the failure, right, within the continent or within countries to be able to establish a framework that allow, corporations between businesses in both countries or within the continent to do business. And that's what you see. That's the offshoot of what you're seeing today.
Okay. So just before I let you go, what role do you think that the private sector should be playing in all of this?
Yeah, the private sector is very, I think it has to do with organization. Today, it's too fragmented. The private sector needs to play a role. It's not just the government that needs to play a role here. The private sector have to come together in the first instance and also invest in infrastructure. It shouldn't be left alone to the government. Politics and all sort of things affect the rate at which things infrastructure can be built. We've seen successes in where PPP have helped fast track development or infrastructural development that we've seen. This happens in Europe, for example, even in the UK and the US, where there's a seamless relationship between the government and the private sector. If you look at the likes of NASIMA, for example, or Lagos Chambers of Commerce, for instance, these are umbrella bodies of businesses, right? It's to say, look, we have been in existence. We know what the pain points are. Can we collaborate with our counterparts in other countries, right, within the continent, to say, look, NASIMA or LCCI partners with maybe Ghanaian or Kenyan chambers of commerce that we houses all the businesses and say, you know what, this is our pain point. We want to invest in rail that will connect, working with the government that will connect both countries, or we want to invest in infrastructure, or identity platform that will make for ease of doing business, right? Because we know the pain point, right? So I think that the private sector shouldn't just be onlookers and sit back and just wait for government to do these things. They need to come together and have that conversation, right? And lay the pain points on the table to say, look, these and these and these and these are the core issues that we have. Beyond just having workshops and doing all sort of things, but also taking concrete steps, in ensuring that they are partners in progress with the government to ensure that the things that they want to see get implemented. And I think that's one of the best ways to look at it. You're beginning to see more people, more business people in government, right? If you look at the kind of things that you're doing in terms of what kind of policies they are pushing forward, it's different from having just 100% politicians who have not really done business, right? Taking ownership of those key sectors. And I think that's basically the very first step. We'll begin to see folks in the private sectors also get into politics, right? And also trying as much as possible to influence those policies that actually favors the business community in a legitimate and transparent way.
That's all we can take on this edition of the show. If you enjoyed today's show, subscribe to Business Front TV for full episodes and catch our clip highlights on LinkedIn and X. I'm Chimgozrim. Thanks for watching and see you next week.